We're now going to move on and look at another additional IFRS 3 issue, which is the two main methods you can value NCI at acquisition. The traditional method is the one we've looked at to date, where the NCI is measured using its share of the fair value of net assets. So you get the subsidiary's net assets at the acquisition date, ordinary share capital plus share premium plus retained earnings, etc. And you multiply by the NCI's ownership percentage. That's what they mean by the proportionate share, whatever ownership percentage the NCI has. We call that the traditional method. It's also called the partial method. So in that method, there's no goodwill attached to the NCI. The other method is called method 2, or the full method. This is where you measure the NCI at its fair value. So you get an independent valuation expert to say, what's the value of a 20% shareholding in this subsidiary? And under IFRS 3, you can choose which method to use for each combination. So for each acquisition you can decide whether you want to do method 1 or method 2. Both of them will result in different NCI valuations, and both of them will result in different goodwill figures as well. The fair value method will have a larger goodwill figure than the traditional method, because in the fair value method there's some goodwill attributable to the NCI as well, because the NCI is measured at its fair value, not its share of the fair value net assets. So I know fair value, that term is mentioned in both, they're two different things, and we'll see that when we go through an example in a second. The other thing to note, and this will make more sense in week 3 and week 4, which method you choose will also dictate how you post journals for goodwill. So depending on whether you use the traditional method or the fair value method, that will dictate how you allocate the goodwill impairment between group retained earnings and the NCI. Just keep a little flag for that, and we'll come back to that in our week 3 and week 4 intergroup adjustments. So let's talk a small little example of a parent plus a sub, right? When we're looking at NCI. So we're assuming for simplicity that the date of the statement of financial position is the date of acquisition. So this is the net assets at acquisition as well. There's no post-acquisition period. And the parent has acquired 80%, the ordinary share capital, of S. That means you have a 20% NCI. And you're told then the fair value of the NCI at the date of acquisition was €40. So let's look at the two different methods then and compare and contrast. First step is that you've acquired 80%, therefore it's 20% NCI. So if we're doing the traditional method, the investment is measured at 110. That's fine. The NCI under the traditional method is measured at its share of the fair value of net assets. So your NCI here is going to be measured at 20% of 100. That's the net assets at the date of acquisition, and you take 20% of it. So the value of the NCI is 20. Then your ordinary share capital and retained earnings, they are 100, and your goodwill is then 30. So that's your first key step. Now what I want you to think about here is split it out. And I will show you this then just to illustrate what I mean by there's no goodwill attached to the NCI. So let's present this slightly differently then in Excel. Let's have a look. We're going to put here the parent, and we'll say 80%, and we'll look at the NCI, and we'll look at 20%. Just to show you them in two different columns. The investment here, and then you have the value for the NCI. So the investment for P paid 110, and we said we valued the NCI at 20. The fair value of net assets, so that will mean in total you'll have 110 and 20, which is your 130. So we're just looking at in total, which is the 100%. So it's useful to just lay it out in this format so we can see what the key difference is between the two methods. The fair value of net assets, that is 100 overall. It's 100. But if you allocated that between them, you'd have 20 here and you would have 80 here. 80% of net assets in the parent share, 20% of net assets in the NCI share. So if you're looking at goodwill, it is still 30 overall. 130 minus 100. But if you look at them here, there's actually no goodwill attached to the NCI, 20 versus 20. It's all attached to the parent. So when you use the traditional method, you're attributing no goodwill to the parent. The goodwill is only attributable attributing no goodwill to the NCI. The goodwill is only attributable to the parent. And that will be important when you're looking at goodwill impairment in subsequent sessions. There's no goodwill in the NCI, so it shouldn't get any goodwill impairment as well. That's why it's called the partial method as well, because there's only goodwill attributable to one portion or partially to the overall business. But you don't need to be able to split it out like that, but it's good to understand the differences at the outset of where they're coming from. Okay, so that's your first one. The fair value method is slightly different. Instead of measuring the NCI at 20, its share of net assets, you ignore that value and you put in 40 instead, which we're told in the question is its fair value, i.e. what's the fair value, the commercial market value of a 20% holding in Sublimited. Remember, the book value is what we're looking at here. That's not necessarily the same as the market value. So it's the difference between what the statement of financial position says and what the commercial value of an entity is. So it's still the 110. It's still the 100 net assets. The only difference is now your NCI is measured 20 higher and your goodwill is going to be 20 higher as well. And now both the NCI and the parent have goodwill attached to themselves. So that's the only difference here, is you're using a different NCI figure, which leads to a different goodwill figure. And the general assumption is in a question, you always assume the traditional method unless told the fair value method. So the assumption is the traditional method unless told otherwise. So if we split that out, we do 110, now we do 40. This becomes 40, that becomes 150. Goodwill becomes 50 because you're paying 150 to 100, and NCI now has goodwill attached. So the parent doesn't change. Their column doesn't change. The only thing that changes is the value of the NCI, the starting point now is 40 instead of 20, and the goodwill is now gone up by 20 to compensate. So essentially you're increasing your assets and you're increasing your equity in the form of NCI. So you'll choose this for each different acquisition, which method you want to undertake. So that's an important one, that you understand the basics there of the difference between the two methods and watching the question which one they're telling you. The general assumption is method 1, the traditional method, unless you're told what the fair value of the NCI is. Then you will include that in the overall answer. And there's your debits and credits for each one. Now bear in mind here, we can do the individual assets and liabilities because the date of acquisition is the same as the date of statement of financial position. In most other questions, you wouldn't be able to do this one. You'd be debiting share capital and retained earnings, but still the same overall entries. But the key difference I want you to focus on is these entries up here, these 5 lines don't change. Same entries in both. The only thing that changes between the two journal entries and subsequently between the two financial statements is the goodwill figure, which is 20 lower, and NCI is 20 lower in the partial method, and it's 20 higher, and the NCI is 20 higher in the full method. So that's your first key implication. The second key implication of the choice will be evident next week when we talk about goodwill impairment as well. So you might put a little asterisk there and say, watch for goodwill impairment next in week 3 and 4, because that will be dependent on which of the NCI methods that you use to value it from the outset. But that choice between the partial and full method is allowed for each acquisition. You don't have to do all fair value or all the partial method. You have a choice for each single acquisition that you make in an organization. So the next 2 slides just highlight the difference in how the statement of financial position looks. There's no difference in a lot of the line items. The only difference is the goodwill and the NCI. So your total assets are 580 and equity and reserves are 580 in the partial method. They jump up by 20 then. Your goodwill is 50 higher and your NCI is 50 higher. Nothing else changes. So don't think, it's not a huge complication. It's just to watch out for in the question which one you want to look at, which one they're asking you to do. So that just gives you a narrative explanation. Don't worry too much about that. If you can follow the numbers, you're more than sufficient in terms of what's required. It's essentially telling you that when you use the fair value method, you're measuring some goodwill into the NCI. So make sure you go back now and have a look at question 2 in the pack that I've given you related to the additional IFRS 3. It's a question called Blues, and that will give you an example of how to use it at the net asset method, method 1, and at the fair value method, which is method 2. Just to hammer home those key basic things before we move on. And likewise, I just mentioned already about the NCI evaluation and goodwill impairment. That actually has a knock-on impact in other parts of consolidation as well. Just put that at the back of your mind, and we'll come back to that next week. All right, so that's another key thing that's an advanced area in IFRS 3. The next thing then is a thing called previously held interest, which is often called a step acquisition or a staged acquisition, which happens in stages. So essentially, for example, you might have bought 20% of a company 3 years ago, and this year you've ended up buying another 50%. So now you have a total ownership of 70%. And it's only now, this year, does that become a subsidiary. Because previously you only owned 20%, that was not controlled. So the key accounting treatment is under IFRS 3, if you have a stepped acquisition, you remeasure any previously held interest to its fair value at the date of control. So for example here, if I talk about it, say in 2017, I bought 20% and I bought it for 1.5 million. Then in 2021, I bought another 50% and I paid 4 million for it. Well, in 2021, I now have control. The date of this transaction is when control assumed because I now owe 70%. You can't go back and say, oh, I had control in 2017. You only had 20%. So the rule or the approach in IFRS 3 is, at this date, you go back and you fair value this 20%. So if that 20% fair value now, and you'll get an independent valuation for this, or you'll be told in the question, is 3 million, you will increase the value of the investment up to 3 million, and you'll put a gain or loss, as it says here, through the P&L. So that's the key point you look at. So you're essentially saying you recognize a gain or loss of fair value at the date of acquisition. And then what you will do is you'll take this 4 million, you'll take the 20%, which is now fair valued, to say 3 million, and that will be your investment, 7 million for goodwill. You take the money you paid now and the fair valued amount of previous. So the key step there is when you have a stepped acquisition, the first step, that partial acquisition that you had from a number of years ago, you fair value that at the date control was assumed. And that fair value then is added to the rest of the consideration for the purposes of calculating goodwill. So again, it's another small complication, but it's not a hugely technical thing. Just what you'll probably get 2 or 3 of those in any exam question where they're all combined together to make it a more realistic question of complications you might see in the real world. Right? We're going to go through a practical example now, and there's another one that you can practice yourself on question 7 in the question pack once this is finished. But again, it's not a hugely difficult area, but just something to watch out for. So for example here, P acquired 3/4 interest in S in 2 stages. Back in 2009, they acquired 15%. It's like a strategic simple investment for 10,000. And then 5 years later, they acquired another 60%. So now they own 75%. So in 2014, at this date, you have acquired a subsidiary. That is the date of control. And you're told the fair value of net assets at the date of acquisition was 80,000. So you will use that for your goodwill calculation. What we're interested now is, well, we know how much we paid for the 60%, 60,000. How much are we going to value the 15% at in our goodwill calculation? And we value that at the fair value, which is 12.5. So the first thing we do in the accounts before we do the goodwill calculation is we bring this 10,000 euro up to 12.5. We recognize a fair value gain. So that will be debit the investment, 2.5, credit the P&L, 2.5. So that's your gain on remeasurement. That's your first debit and credit. And you will see that here, debit investment 2.5, credit your gain 2.5. That's the first step. The second step then is we're back to normal. Essentially now you see it is we own 75% of S and we paid 60 plus 12.5, which is 72,500. That's the value of the investment, which they've used here. 60 and 12.5. So it's just like you're bringing the step up, and once that comes, you go to a normal goodwill calculation. The NCI is measured at its share of net assets. You're told in the question, net assets are 80,000. So if we now own 75%, that means the NCI is going to be a quarter, 25%, which its share of net assets, a quarter of 80,000, it's initially going to be valued at 20,000. And that's how you calculate your goodwill. So actually, for most of these here, NCI and whatnot, consider once you get the investment figure After that, goodwill doesn't change. The calculation of goodwill has been the same the whole time. It's about getting the components of the goodwill calculation that takes a bit of work. And that's where the advanced IFRS 3 issues come in as well. So you can see the journals, recognize the additional investment at the 60,000, debit the investment of the parent, credit the bank. We've already talked about the remeasurement in a stepped acquisition, and then you record the journals. You get rid of the equity, ordinary share capital and retained earnings. We're not given the breakdown, so we just put debit equity to get rid of it all. You get rid of the investment, which is no longer there, which is made up of the 60 and the 12.5, and you recognize goodwill, and you recognize an NCI at its share of net assets. Now these take time. I know we're going through them now for the first time. You'll have to go back over it. Particularly, I'm a big fan of the Mahoney textbook. The Mahoney-McLaughlin textbook, particularly the relevant chapters in this, including a chapter on previously held interest. That's your first starting point if you want to get more into this. And also remember you have question 7 in the pack to get an example as well. But that could be a smaller part of a bigger exam question. So it's important you put some context into it. You need to know these little bits and pieces because it can form part of a bigger question. But not a huge amount where you have a stepped acquisition. So we've dealt with then different types of consideration. We've dealt with the 2 ways to measure the NCI. We've dealt when you have a situation where you have a stepped acquisition, acquiring a subsidiary in multiple steps. And now we're also thinking, well, is there any issues in terms of getting the fair value of net assets at the acquisition date? So one of the key rules in IFRS 3 is when you bring in a subsidiary into the group accounts, all the assets and all the liabilities must be at their fair value. Now, and that we end up having some fair value adjustments then to land or to buildings, depending on whether some of them are below their fair value. And that's an adjustment we're going to come across next week again, dealing with that fair value and the impact it has on goodwill. But one thing I want to highlight here in bold is the application of some recognition criteria can have assets and liabilities in the subsidiary that have not previously been recognized. You might think, what does that mean? Well, IFRS 3 can override or create some new assets that you wouldn't have had before. Right? And it's probably the best to look at examples here because this can be confusing to students at the outset. So take, for example, here, assets and liabilities that were not previously recognized. One of the key rules in IAS 38, which you would have covered in your undergrad, is you cannot recognize internally generated intangible assets. So if you generated brands or customer relationships internally, you cannot recognize them because we can't quantify them. There's no figure to put on it. The difficulty is here, or the change, once you buy those as part of a subsidiary, then they do meet the recognition criteria. So that means when you buy a subsidiary, you have to, in some way, allocate some of what you've paid, i.e. the purchase price, to these different types of assets, particularly intangible assets like brand names, patents, and customer relationships. And this process is called the purchase price allocation, where you take the purchase price that you've paid for a company and allocate it to the various assets. And whatever is unallocated at the end, that is your goodwill. But that will result on the creation of some new assets that wouldn't necessarily be in the subsidiary's own accounts. Because in the subsidiary's own accounts, they would be seen as internally generated and wouldn't meet the recognition criteria as IAS 38. But once they are acquired as part of an acquisition, you can now put a figure on it. And that's where the purchase price allocation process comes in. Now, in an exam question, we tell you what the allocation is. So you'll be able to allocate it across, but it's important to realize that these new assets can be acquired, can be recognized as part of an acquisition. So look, for example, here, you can see Glanbia and Kerry Group as 2 good examples. So we see Glanbia's acquisition of SlimFast. We looked at this one already. You can see they paid 335 million. And when they looked at the fair value net assets, they found software worth 100,000. But look at the 2 biggest assets, the brand names, 120 million, and customer relationships, 62. Those 2 would not have been included in SlimFast's own accounts until the acquisition took place, because then you can put a figure on it through a purchase price allocation. You take the 335 million and you try and figure out how much of that is attributed to assets. They attributed between assets and liabilities about 198 million. So whatever's left over then, the difference is your goodwill, 137. And if you go and look at Glombia's accounts, look at their, for example, their statement of their balance sheet. So look at the company balance sheet and look at intangible assets. It's 1.3 billion. It's the biggest amount. And we look at note 17 down here. Brand and intangible assets make up 680 of it, about half of it. These are all coming from acquisitions that they've made. And they've recognized brands and they've recognized intangible assets as part of that, whether it's customer relationships, patents, etc. And they are all then amortized. You can see here the amortization software about 6 years, and they tell you then the amortization of brand names and whatnot. They might have no use, an indefinite useful life. So they don't tell you anything else about the brands are here. So all the different brand names and the values that they have, because they've acquired all these businesses. See the SlimFast band, 120, Isopure, BSN, Optimum Nutrition. Each of these have happened from a previous acquisition where they've all been allocated a certain amount. Right? And then you have an amortization period. So one brand has an indefinite life, so it's not amortized. The rest have a number of different useful lives. So you'll see how many is left for brand names and then for customer relationships as well. That's all coming from acquisitions and this thing called a purchase price allocation, where a valuation expert, likes of a corporate finance team, will allocate and value the brand, value the customer relationships. So that's an unusual one that you wouldn't have come across before. It's an exception kind of what you're used to in IAS 38. And you can see the same for Kerry Group in an acquisition on page 196. The other thing to note here is there's another two exceptions, or one main exception at least, is contingent liabilities. Traditionally, in IAS 37, you would not recognize contingent liabilities because it's only possible, it wasn't probable at the date of acquisition. However, in IFRS 3, it's an exception. If a subsidiary has a contingent liability at the date of acquisition, the parent should recognize it. So IFRS 3 overrides IAS 37. That if there is a contingent liability in the subsidiary at the date of acquisition, even if it's not in the subsidiary's accounts, because it shouldn't be under IAS 37, when the acquisition occurs and you're doing group accounting, IFRS 3 overrides that perspective. Now, there are other exceptions around how you measure assets in IFRS 5 and how you recognize tax liabilities. But again, we'll talk about tax in a second. The two main ones are the exceptions in IAS 38, the creation of these new intangible assets once they have been acquired and they can be allocated a figure of a value, and also contingent liabilities, which is an exception to IAS 37. And you will see some of those in question 5 in your question pack as well. Just a key thing to keep an eye out. So there are a number of different complexities when you get to more real world acquisitions to deal with. So the last thing then we're looking at is, well, what happens if deferred tax is brought in? Now, if deferred tax is not mentioned in a question, you leave it out completely, right? Unless it's brought in explicitly, you don't need to consider yourself. So an example here, during 2014, Company A acquired Company B, all of Company B. So there's no NCI for 50,000. Fair value net assets is 5,000 and included in property, plant and equipment was revalued to 5,000 in consolidation. The tax base of the assets and liabilities acquired other than PP equaled their carrying amount. The tax base of PP was nil. Right? So that means you're going to have a deferred tax liability. Because you're revaluing property, plant and equipment up and it has a nil tax base, that means this is going to be a deferred or a taxable charge. So you're going to have a deferred taxable charge, which you're going to look in the future. So that's the difference. We call it a taxable temporary difference. And you're going to multiply that by the tax rate to get your deferred tax. So there's a link back here to IAS 12. So we're saying 5,000 is the taxable temporary difference and the tax rate is 28. So the deferred tax liability is 1.4 million or 1,400 in this case. So you actually include that when you're calculating the net assets. You've paid 50,000 for net assets that you thought were worth 25. However, as part of those net assets, you're also inheriting a deferred tax liability. Because remember, when you buy the company, you inherit the deferred tax liability as well. So all you do is you put it into the goodwill calculation as a liability, and it sits as a liability in the group accounts. Nothing more complicated than that. You won't be asked to do a deferred tax calculation unless it's a separate piece that might examine some semester one material. But if this was a deferred tax as part of a business combination, I would give you what the deferred tax liability is, or I'd present it like that, and you'd be able to calculate it quite quickly. The only way deferred tax might come up in consolidated question in more detail if I was giving you a scenario about the parent and I wanted to examine some semester one material the Karen Ann would have covered. So from a business combination perspective, that's as complex as it would get for deferred tax. All right, so they're the key things to watch out for. All right. So the other areas to watch out for is restructuring provisions are rarely recognized. So even if you buy a subsidiary and you're thinking, I'm going to restructuring this company, these are not allowed in IAS 37. And there's no exception, unlike where you're talking about contingent liabilities. There's no exception. The requirements of IAS 37 must be met. Similarly here, if you acquire a subsidiary and you expect that subsidiary to be loss-making into the future, you're not allowed to recognize liabilities for future losses because again, it doesn't meet the criteria in IAS 37, which you would have covered back in your undergraduate studies. So they are not exceptions to the recognition criteria. In IAS 37, the only exception is to do with contingent liabilities. So lastly, then your last step is your goodwill. If your goodwill is positive, it's a non-current asset, intangible. And if your goodwill is negative, that's a gain on bargain purchase. Now, just to note, they always say a gain from bargain purchase is rare. And before you recognize the gain, IFRS 3 says you should check that you have all assets and liabilities identified, check that you've measured consideration appropriately, and reassess the values you've put into assets and liabilities. So essentially IFRS 3 is saying is, hold on, if you're getting a gain here in your calculations, just double check everything because gains are quite unusual. Now there might be situations where there's a company that's in distress or there's a fire sale of assets going on that can lead to a gain from bargain purchase. But oftentimes in the real world, they're a lot rarer than you would have in terms of goodwill. Goodwill is a more obvious one that you're paying a premium of the assets to buy the company or to buy control in the company. IFRS 3 also allows a very practical consideration that the difficulty with some of these acquisitions is they may happen very close to the year end. And what can happen then is, well, for example, if you look at here, the example of uh, SlimFast, they acquired that on the 19th of November. So that's very close to the year end. So the difficulty is you can't do all this accounting, can't get the fair value of all of these accurately within the space of 4 or 5 weeks. So what IFRS 3 allows you to do is this thing called provisional accounting. Right? So it allows the acquirer 12 months from the acquisition date to adjust any provisional values in the assets and liabilities or the consideration. Because they know it takes a while to account for an acquisition. It can't be just done overnight because there's a lot of work in that purchase price allocation, valuing brand names, valuing customer relationships. It's fine if the acquisition happens early on in the year. You have time by the 12 months to get it complete and finalized. But the likes of here in, for example, SlimFast acquisition, that happened very close to year end. So what they say here is the initial assignment of fair values for net assets has been performed on a provisional basis. Any amendments to these fair values within the 12-month time frame will be disclosed in next year's annual report as stipulated by IFRS 3. So that's essentially just saying it's a pragmatic provision that allows you to do an initial estimate in the first year, and in the following year's annual accounts, if there's any update, as long as it's within 12 months, you can put those through and you don't have to make a prior period error or anything like that. So that's a very practical adjustment. Right? So that's a useful one just to get an idea. In practice, it doesn't always work out ideally, just depending on the timing of transactions. So you can have a look. A CRH is a good example. I showed you that before. And also the Glombia one in terms of the acquisition of SlimFast is another good example. Particularly look at the level of detail. Right? If you look at the acquisition here, it gives you information on the background, all the detail of the assets, liabilities, consideration, and then it continues on all the impact in terms of the profit or loss and the revenue for each of the years. So there's a lot of acquisitions that occur to give you an idea of what goes on. Right? Interestingly, if you see here, acquisitions they made last year, Amazing Grass and Body and Fit, for which fair value of assets and liabilities were determined provisionally. They say there's been no revisions in the provisional values other than an increase in goodwill. So the ones that they provisionally acquired for in the previous year's annual report have now been finalised, and they've only made a small adjustment of $500,000. So if you go and look at Glombia's annual report for this year, they'll qualify whether or not the slim fast provisional ones in 2018 have been finalised, and if there's any difference been noted. So it just shows you how these things flow in. So that's why it's always useful to look at practical real world annual reports, because it gives you a real world feel for how the stuff we cover in class, the IFRS 3, the IFRS 10, is applied in the real world. All right. So your key takeaways are there's 5 key steps in IFRS 3. Along each step, there's complications. And this is master's level now. And as we move towards the end of the question packs, where you get harder and harder questions, and as we move on to exam level questions, you'll start to see 2 or 3 of those trickier aspects brought into every question. So you need to practice the concepts, and you also need to practice your debits and credits, because that forms part of the core knowledge of consolidations. All right, so that is the core reading for this week, is those 2 recordings in Advanced IFRS 3. At the start of next week, I will put up Revision Quiz 1, which covers everything up to and including Advanced IFRS 3. Next week then, in the webinars and in additional recordings, we'll start to look at intergroup issues, which are otherwise known as intergroup adjustments.